Hi guys, I'm Oliver from Elva E-Commerce Accountants. Welcome to our YouTube channel. So today we're going to be talking about a topic that comes up a lot in our e-commerce Facebook group, sole trader versus limited company. So you're ready to set up your e-commerce business, but you're not yet sure which legal structure to go for, a sole trader or a limited company. Well, today I'm going to be talking you through limited companies, sole traders, and the pros and cons of each. So let's have a look at what each of those options actually mean. A sole trader is a self-employed person who is the sole owner of their business. This is a legal structure typically used by smaller businesses, particularly ones that plan to stay small in the long run, so perhaps a decorator or a gardener. A limited company is viewed as a separate legal entity in the eyes of the law. So let's start off by having a look at the pros of being a sole trader. Setting up as a sole trader is easy to do. You just need to fill in a simple online form on the HMRC website and you're good to go. Whilst it isn't mandatory, I would strongly recommend also setting up a separate business bank account, as this will make it much easier to track your income and expenditure. There's also less admin involved. As a sole trader, all you need to do is file an annual self-assessment tax return with HMRC. This is due on the 31st of January in the year following the tax year in which you started trading. Your accounting fees will be lower for a sole trader when compared to a limited company. Here at Elva E-Commerce Accountants, we typically charge around £40 per month less for accounting packages for sole traders when compared to limited companies. If you've got some knowledge in this area, or perhaps even a helpful friend that's done their own tax return before, you may even be able to do a self-assessment tax return yourself and avoid paying for an accountant altogether. As a sole trader, if your turnover is less than £150,000, you have the option to prepare your tax return on a cash basis. This is as opposed to the traditional accruals method of accounting, which is more commonly used. Using the cash basis is a simpler option as it requires less accounting knowledge to be able to follow. It can also be very advantageous in your first year of trading if you're not a dropshipper and you hold stock in your business. This is because you'll be able to get a tax deduction for any stock you have purchased and paid for in the first year of trading but not yet sold. Under traditional accruals method accounting, you would only get a tax deduction for stock that has been sold prior to the year end. It's worth pointing out that whilst this does seem like you're saving tax by doing that, ultimately all you're actually doing is deferring your tax liability, as you still get a tax deduction for that stock under the accruals method of accounting, just only once you've sold it. Being a sole trader is good for privacy. You don't need to disclose any financial information publicly. You only need to file it with HMRC, who won't disclose this to anyone else. This next point is a pro, but often not one that a new business owner wants to think about. You can offset the losses of your sole trader e-commerce business against other income. So if you're starting up your e-commerce business as a bit of a side hustle and are still working another job to supplement your income, and let's say perhaps you invest heavily in the business and in building the brand in the first year, and you end up making a loss, you'll be able to offset these losses against your employment income and potentially get a tax rebate. So that's just about all of the pros of being a sole trader. Now let's have a look at the cons. You don't have any flexibility over when you draw your income from the business. This means that the tax year that you make a profit in is the tax year that profit has to be taxed in. That means if you have a good year and are earning enough to pay higher rate or additional rate income tax, you haven't got much choice but to pay those higher rates of income tax. This is by far the biggest downside to being a sole trader, and the one that pushes most business owners towards being a limited company. Another downside of being a sole trader is that the liabilities of the business are also your personal liabilities, and the liabilities of the business are unlimited. That means if the business goes wrong and runs up debts, you will be personally liable for these debts, and you could be forced to sell your house and anything else of value in order to settle the debts of the business. If you want to bring friends, family or investors into the business and give them a share of the profits, you won't be able to do this as a sole trader. You'll need to switch to either a partnership or a limited company structure. Now let's have a look at the pros of being a limited company. You have complete flexibility over when you take your income from the company. This is because you and the company are separate legal entities, and you only have income personally when the company pays you a salary or dividends, not as soon as the business makes a profit, as is the case for a sole trader. It's commonly the case that business owners will choose to limit their income from the business to £50,000 to avoid paying higher rate income tax. Any profits above this level can be retained within the business, with only corporation tax at 19% needing to be paid on them. This can be particularly helpful if you're starting out and wanting to reinvest the profits in growing the business. A limited company has limited liability. That essentially means that in the event the company goes wrong and ends up insolvent, your liability is limited to what you've invested into the business. The bank or any other creditors won't come after your house or car like they would if you were a sole trader. An important caveat to that, however, is that many banks will ask for a personal guarantee for business loans. If you've signed a personal guarantee, then you'll be personally liable for any debts that the guarantee applies to, in the event that the company is unable to repay them. Another positive of being a limited company is how this will be perceived by others. Lenders will often view a limited company as being more credible, and so you may find it easier to get financing as a result. You will also appear more credible to your customers. However, for e-commerce businesses, this is really quite a minor point, because for example, if you're an Amazon seller or if you've got a Shopify store, 99% of the time, a customer isn't going to check for the legal structure of the company they're buying from, are they? The reality is that the credibility that comes from having a limited company is more relevant to a business that is selling to other businesses rather than those that are selling direct to consumers. Finally, let's have a look at the cons of being a limited company. There's quite a bit more admin involved in running a limited company when compared to a sole trader. As a company director, you'll still need to register for self-assessment and file an annual self-assessment tax return, like a sole trader. In addition to that, the company will need to file annual accounts with Companies House and a corporation tax return with HMRC on an annual basis. These are due 9 months after the year end of the company. In addition to this, you'll also need to file an annual confirmation statement, which is confirmation of the basic details of the company, its shareholders and its directors. So, because you've got all of this extra admin, which is a lot more complex than that of a sole trader, you're going to need an accountant. Here at Elba E-Commerce Accountants, we typically charge around £40 per month more for a limited company accounting package when compared to that of a sole trader. This is because of the extra reporting requirements of a limited company. Another downside of being a limited company is that some information does get displayed publicly on Companies House. For a small company, this would be the directors and shareholders' names and their months and years of birth. The company also needs to display its registered office address, and the directors need to display a correspondence address on the Companies House website. You can, however, use the address of a company formation agent or an accountant if you don't want to use the address of your business. The accounts you file with Companies House will also be available for the public to download. However, for a small company, this information is quite limited. So that's everything that I wanted to talk you through on the pros and cons of being a limited company. Ultimately, there's no right or wrong answer on whether to be a sole trader or a limited company, and it really does depend on your personal circumstances. However, as we've touched on in talking through the pros and cons, there are a few situations where it would make more sense to go for one rather than the other. So let's take a quick look at those before we wrap up. If you think your e-commerce business is going to make a loss to start with, but you expect to have income from other sources, then it will make sense to be a sole trader. That's because you'll be able to offset the loss from your e-commerce business against your other income and reduce any tax due on that income. If you go for a limited company, you won't have that option. On the other hand, if you expect your business to be profitable in the first year and your total net income will be more than £50,000, then it's highly likely that a limited company will be the best option for you. This is because it will give you flexibility over when you take income from the business, and so you'll be able to minimise or eliminate any higher rate tax that you need to pay. If neither of the above options apply, and you're not a dropshipper and you're going to be holding stock yourself, and you expect to have turnover of less than £150,000, then it makes sense to be a sole trader. This is because you'll be able to get a tax deduction for any stock you haven't yet sold at the year end. Well, thanks for watching our video today. I hope you found it useful. If you did, please subscribe to our YouTube channel using the link just below. And if you have any friends or family just starting up in the e-commerce space, then please send them a link to this video, as I'm sure they'd find it helpful too. If you have any questions, please feel free to drop them in the comments. Bye guys.